best traffic. Larry Olds at Bloomberg 960 at 103.7 FM HD2. John.
All right, thanks, Larry. Let's get the weather forecast. I don't think I'm going to be too controversial by saying that this is a nice forecast, Gary Best.
It certainly is. And even the fact that we have a weak front over us right now, but just some passing clouds with that front, and there's no precipitation. So for today, partly to mostly sunny, breezy along the coast, 60 for the Bay Area, 70 well inland, tonight mainly clear skies, and cool, temperatures 40 and 50, coolest weather for the North Bay. Sunny skies return for tomorrow, just a few degrees milder actually, 65 and 75 near the Bay, and about 70 to 75 for the inland. 40s and clear skies on Thursday night, really not much change in the Friday and the weekend. Mostly sunny skies, temperatures mainly ranging from the mid-60s to low 70s. This is Gary Best on Bloomberg 960 and 103.7 FM, HD2. John?
Gary, thanks a lot. Appreciate it. Boston leaping over the city to land in second place on the list of most expensive U.S. rental markets. It's a surprise to some. The new report on metropolitan areas from Zumper, this is the rental listing company, says the median one-bedroom rent in San Francisco dropped 2.6%. Right now it's hovering around $3,020 a month. Sure, you can afford that. San Francisco is struggling to recover from the pandemic as tech companies still embrace remote work. 50 and clear in San Francisco. Just ahead, check out the markets. This is Bloomberg. Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 1061 to San Francisco. Bloomberg 960 to the country. Sirius XM channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Markets.
All right, coming up in this half hour, we're talking fixed income. We're going to do it with the good folks at TCW. They are really smart. They were bearish coming into this year in fixed income, and boy, were they right. Plus, I just read a story about Boeing. Let's check in with George Ferguson. He covers aerospace, defense, the airlines. We're going to get the whole kit and caboodle. What's going on with the airplane business, which is one of my favorite businesses to talk about.
As you speak, Paul, the NASDAQ Composite Index looks like it's about to turn green, down just about 2 points right now. You have defensive shares helping push the major averages. Healthcare, energy, best performing in the S&P 500. Will the Fed take a cue from the Bank of Canada? BOC this morning dialing back the pace of rate hikes amid recession fears. Speculation, the U.S. Central Bank might be thinking about the same as a result. Other narrative, of course, tech earnings, they disappointed. Morgan Stanley's Mike Wilson says stocks can still get a lift from, he maintains, is still a bear market. Bear Wilson also telling Bloomberg the bear market in U.S. equities may conclude sooner than investors think. How about the first quarter? Put all this into a blender, turn it on, what do you get? The S&P 500, 24 points higher. That's up 0.6%. The Dow Jones Industrial Average up 320 points. That's a rise of 1%. The NASDAQ Composite Index right now, I'm going to call it unchanged. How about that? And as for yields, the 2-year down 5 basis points, 440. The 10-year down 10 basis points, 399. Energy is still higher. Taking a look right now at the commodity space, NYMEX crude is up $2.69, 88.01 a barrel. We check the markets for you every 15 minutes during the trading day right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash Call.
All right, John Tucker, thank you so much. We appreciate that. Let's get right to our next guest, Brian Whalen. He's a co-CIO and generalist portfolio manager at TCW Fixed Income Group. He went to some college in Connecticut that's best known for its pizza, but what really gets my attention, he was a former VP at Donaldson, Lufkin, and Genred. For those that don't know, that was one of the premier firms on the street before Credit Suisse bought it and kind of destroyed it. But what's really good about the DLJ people is they trained some of the best analysts on Wall Street, so keep that in mind. Brian, I got double-digit declines everywhere I look in the fixed income space. People are telling me this has never happened before, so of course I want to jump in with both feet and start buying everything. What do you think of my strategy?
I like it. You had me at the intro, and now you've got me with the support for the bond market. Completely agree. We're at such a different place right now. I mean, we started the year, the 10-year is at 1.5%. You look at your kind of standard bond fund today, you're looking at a yield of somewhere between 5.5% and 6%. There's plenty of opportunities around, not only just the yield, but the potential opportunities you can get in credit. Not to say there won't be more, but it's a different conversation about the bond market today. Not only get the yield, but there's a strong argument to be made that bonds can be what they're supposed to be in your portfolio, which is a diversifier versus other assets like equities.
It's amazing to me how quickly Tina went away. There is no alternative. Now it almost feels like there's too many alternatives. There's so much opportunity, so many juicy yields in the bond market. I mean, where do you see the most opportunity at this point?
Yeah, good question. For us, the first 10 months of the year, it's been a kind of, we've called it a high quality sell-off. So where have you seen most of the repricing? You've seen it obviously in treasury rates. We just talked about that. And then other higher quality, larger parts of the bond market, like agency mortgage-backed securities, like investment-grade corporate bonds. Those have kind of repriced the most and look the most attractive at this point. But if our outlook is right, and it seems to be coming to more consensus, which is that we're clearly heading into a deep slowdown, a recession, you're probably going to want to keep some powder dry for credit opportunities, meaning that areas of the bond market like leverage finance, high yield leverage loans, parts of the bond market where you're exposed to kind of lower quality types of borrowers in the commercial real estate area or the residential mortgage area. You're going to want to keep that powder dry because those parts of the market really have not repriced. The spreads or the prices you see in those parts of the market are not reflective of a recession. And so that's with regards to our strategies, we've jumped with both feet into the former, into the kind of higher quality parts of the market, but still being cautious on the lower quality parts.
So, I spent a couple of years early in my career at the Chase Manhattan Bank, so doing credit analysis. So I've got some chops there. I'm not just an simple equity guy, but my question is, I'm concerned if we go into this recession about credit quality. So you're suggesting that is in fact a risk, and that is suggestive of maybe focusing on quality right now as opposed to maybe trying to grab for some extra yield?
Yeah, I mean, look, when let's look at like corporate balance sheets, they're actually not as levered as we saw them in late 2019. And part of that is, it's the upside inflation, right? Debt is a nominal problem. And so when you have inflation and debt stays relatively constant, your ability to service that debt actually looks fairly healthy right now. It doesn't look bad. That said, if we enter a recession, there'll certainly be some things that go bang in the financial markets. That will dry up liquidity, and you will see that reflected in wider spreads, higher yields in those parts of the corporate bond market. It doesn't necessarily mean we're going to see defaults, the same types of default levels that we saw in the great financial crisis or during the kind of the 2001, 2002 tech bubble burst. But there could be a period of time, and it could last months, where the high yield market is priced like that. And now that would be a buying opportunity because you could get prices reflective of a high default cycle, but in reality, over the ensuing 2-3 years, you may not get, or most likely will not get, those types of peak default rates, and that will lead to very good returns.
Brian, let's wrap the Fed into this as we count down to next week's meeting. I'm going to ask you a version of a question I'm obsessed with this morning, which the idea is that bad news is good news. You have, signs of cooling economic data, and I know you're a credit guy, but you look at what we're seeing in the corporate earnings results, the impact of a higher dollar, slowing ad demands. When you add all that together, what do you think it means for the Fed, and what do you think that means for the fixed income universe at large?
We think the Fed's going to go as far as the market allows them, meaning that it's been fairly surprisingly orderly kind of year to date. Like we haven't really, I mentioned those bangs in the financial market. We haven't seen them. So, the Fed's going to try to get well north of 4%. The market's got it priced in somewhere between a 4.5% and a 5% funds rate. What might stop them from getting there is something that goes, really goes bang. It's kind of the equivalent or even larger of that kind of UK pension LDI problem, we here in the States.
Yep.
That may cause them to kind of stop. Or, let's say, unemployment jumping up surprisingly or a little more quickly, than the market's anticipating. But long story short,
right,
the bond market right now is allowing them to, is kind of pricing and allowing them to get north of 4.5%. And if they're giving it to them, they're going to take it.
All right, good stuff. As always, Brian Whalen, co-CIO and generalist portfolio manager, TCW Fixed Income Group. They manage like $225 billion. How do you even do that? Good stuff from Brian. Right now, let's head down to Washington, D.C., get